They took their best shot. They waited for the cover of darkness, utilized the distraction of the general election cycle, and hoped you wouldn't notice the knife twisting in the back of the global economy. But when the sun rose over Shanghai this morning, the outcome was still standing, staring the Western banking cartel right in the face. For decades, the control of silver prices has been the playground of London and New York. They print the paper, they set the price, and they dictate the terms. But overnight, the rules of engagement changed forever. We aren't talking about a minor adjustment or a temporary fluctuation. We are talking about a fundamental severance of the supply chain that has kept the West comfortable and the prices suppressed for 50 years. China has effectively pulled the plug. They have flipped a switch that transforms silver from a tradable commodity into a weapon of economic warfare. The establishment wants you to think this is just another trade dispute. They want you to believe this is business as usual. But let's be clear, business as usual died yesterday. The game is over. The resource war has officially begun. While the media focuses on the Nasdaq hitting all-time highs and distracts you with the latest political circus in Washington, the real story is bleeding out of the Asian markets. This is a lie of omission so massive it borders on criminal negligence. Turn on CNBC or Bloomberg right now, and what do you see? You see talking heads discussing AI stocks, interest rate pivots, and consumer sentiment. They are rearranging deck chairs on the Titanic, while an iceberg the size of the Chinese manufacturing sector rips a hole in the hull. What they are hiding from you is a specific regulatory change regarding the export VAT rebates on photovoltaics and strategic metals, specifically silver. This isn't just a tax tweak, this is a blockade. By removing the incentive to export silver-heavy products and raw bullion, Beijing is effectively locking the doors. The metal stays in China. The inventory that the COMEX and the LBMA rely on to settle their paper contracts, it's gone. It's not coming. And without that physical flow, the paper charade collapses. While everyone was watching the stock market bubbles, the foundation of the physical world was quietly removed. Do you see the problem yet? They are keeping you looking up at the fireworks while the ground beneath your feet is turning into quicksand. This matters right now because we are mathematically past the point of no return. We are not looking at a future prediction. We are looking at a mathematical certainty that is unfolding in real time. Look at the numbers. The Silver Institute has already projected a deficit, but those numbers were based on a free-flowing global market. With China's new kill switch rule on exports, that deficit doesn't just double, it becomes a vacuum. We are talking about companies like Samsung, Tesla, and huge swaths of the relentless Chinese solar sector consuming over 115 million ounces annually, with zero intent of letting that metal leave their borders. This isn't theoretical. On December 12, 2024, inventory levels at the Shanghai Gold Exchange began to diverge violently from the COMEX. The arbitrage window is closed. If you are holding paper silver contracts with JP Morgan or sitting in an unallocated pool account, you are standing on the tracks and the train is coming. In this investigation, we are going to expose the mechanism of this default. We are going to show you why $32.50 silver is a fabrication and why the real price, the price of physical possession, is about to detach from reality. This is not a drill. The supply shock is here, today. We're going to look at the specific language of the new Chinese trade regulations that the Western media is refusing to translate for you. We're going to explain the short squeeze mechanics that are building up in the futures market, a pressure cooker that makes the GameStop saga look like a child's tea party. We're going to show you the exact correlation between the drain on the registered vaults and this new geopolitical strategy. We will break down the timeline of the inevitable failure to deliver. You need to understand who the players are, why the banks are trapping themselves, and most importantly, how you escape the blast radius. If you thought the nickel squeeze was crazy, wait until you see what happens when the most electrically conductive metal on Earth simply vanishes from the open market. This is the story of the greatest wealth transfer in human history, and it all starts with a single signature in Beijing that nobody in Wall Street wants to talk about. Buckle up. To understand why this matters, you have to understand the fundamental lie that holds the modern financial system together. They have sold us the idea that price discovery happens on a screen. They want you to believe that a digital contract representing 5,000 ounces of silver is the same thing as having 50 100-ounce bars in a safe. It isn't. For 40 years, the West has operated on a fractional reserve system for commodities. For every 1 ounce of real physical silver in the vaults, there are hundreds of paper claims traded daily. This system works until it doesn't. It works as long as nobody asks for the metal. It relies on the just-in-time delivery method. When a factory in Germany needs silver, they assume they can get it from London. When a refiner in Switzerland needs bars, they assume they can source them from the global float. But silver isn't just money anymore. It is the strategic lifeblood of the 21st century. It is the crucial component in photovoltaics, solar panels, in every Tomahawk missile, in every iPhone, and in the guidance chips of every EV. Without silver, the green revolution stops. Without silver, the modern military-industrial complex goes dark. And China knows this. They realize that by controlling the physical stock, they don't just control the price, they control the technological destiny of the West. Let's do the math, because numbers don't lie, even if central bankers do. The global silver market is currently running a structural deficit. According to the latest data from the Silver Institute, demand outstripped supply by nearly 200 million ounces last year. That was before this new Chinese restriction. Now let's look at the kill switch. China is the world's largest consumer of silver for industrial application, specifically regarding the solar gigawatt expansion. By removing the VAT rebates, essentially an export tax credit for silver-containing products, they have created a domestic gravity well. It is now 13% more expensive to sell silver outside of China than to keep it inside. This creates an arbitrage wall. Western spot prices are hovering around 31 yuan to 32 yuan. But inside China, the premium has skyrocketed. We are seeing premiums of 350 to 4 yuan over spot. Why would a Chinese refinery sell to the COMEX in New York at a loss when they can sell to a solar manufacturer in Shenzhen for a massive profit? They wouldn't. This breaks the mechanism of the COMEX. The COMEX relies on the ability to source metal globally to satisfy delivery requests. If 30% of the global refining capacity is suddenly locked behind a do not export wall, the eligible category in the COMEX vaults cannot be converted to registered fast enough to meet the demand. This is exactly what happened with palladium, but on a scale 10 times larger. We are talking about the float. This is the metal available for sale, not the total inventory, shrinking to effectively zero overnight. When the float hits zero, price becomes irrelevant. You cannot buy what is not for sale. Do you see the problem yet? The Western banks are short millions of ounces that simply do not exist in the accessible market anymore. This is exactly what happened in 1980, but the mechanics are reversed. In 1980, the Hunt brothers tried to corner the market by buying everything. Today, the market is being cornered by a sovereign superpower refusing to sell anything. It also echoes the rare earth embargo of 2010. Remember when China cut off rare earth exports to Japan over a territorial dispute? Prices went vertical overnight. Electronics manufacturers panicked. But silver is far more critical than rare earths because it serves two masters. It is an industrial necessity and a monetary asset. We can also look at the nickel crisis on the LME in 2022. When the Big Short, a Chinese tycoon, got caught on the wrong side of the trade, the exchange had to halt trading and cancel trades to save the banks. That is the blueprint. History is repeating itself, but this time, the exchange won't be able to just cancel the trades because the demand isn't speculative. It's physical. Apple needs the silver to make phones. They can't accept a cash settlement. They need the metal. When industry starts fighting investors for the same shrinking pile of physical bars, the price cap blows off. We are walking into a repeat of the 1970s stagflation crisis, combined with the 2008 liquidity crisis, focused entirely on the metals market. This creates a liquidity crisis of epic proportions. The trap is set. The Western bullion banks, the likes of JP Morgan, HSBC, and others who act as the custodians of these vaults, have spent years suppressing the price to discourage you from owning it. They flooded the order book with paper shorts. But now, they are the ones trapped. They have sold insurance on a burning building. As the kill switch activates and the flow of silver from east to west stops, the registered inventory on the COMEX is going to plummet. We are already seeing it. Withdrawals are accelerating. We are seeing days where 3 million ounces leave the vault and 0 come in. At this burn rate, the COMEX goes effective 0 in months, perhaps weeks. This is the breaking point. The moment a major industrial user stands for delivery and is told, "We don't have it," force majeure will be declared. And that is when the paper price goes to 0, and the physical price goes to the moon. Let's analyze player number 1, China and the BRICS alliance. Their motivation is transparent if you stop listening to what they say and watch what they do. They are accumulating real assets while dumping U.S. debt. China knows that in a multipolar world, he who holds the resources makes the rules. By activating this export restriction, they are engaging in resource nationalism. This is a strategic calculation. They are building out the massive Belt and Road energy infrastructure. They need billions of ounces of silver over the next decade to achieve their solar targets. If you're China, you have two choices. Option A is to let your precious silver resources flow to the West in exchange for depreciating US dollars. Option B is to hoard the silver, support your own high-tech manufacturing dominance, and starve the Western tech sector of essential inputs. They have chosen option B. They are weaponizing the supply chain. This isn't just about economics, it's about national security. They are securing the physical collateral for a new financial system while simultaneously kneecapping the US dollar's ability to price commodities. They want you to believe they are just adjusting tax policy, but in reality, they are seizing the board. They are playing chess while the Federal Reserve is playing checkers. Then we have player number 2, the bullion banks and the Western financial establishment. These entities operate on the fractional reserve model I mentioned earlier. Their motivation is profit through fees and management of the paper price. For years, they have utilized spoofing, placing fake orders to drive prices down, to trigger stop losses and shake retail investors out of their positions. They rely on the assumption that they can always lease or borrow metal from central banks to cover their shorts. But here's the kicker. That metal is running out. While China was hoarding, the West was selling. The UK's silver exports to India and China have been staggering. The vaults in London have been drained to feed the insatiable appetite of the East. Now the banks are naked short. They are exposed. As the price begins to rise due to the shortage, they are facing margin calls. Every dollar the price goes up costs them billions in paper losses. Their only move is to double down, to print more paper contracts to try and flood the market with fake supply. But this only digs the hole deeper. They are fighting gravity. They are trying to hold a beach ball underwater, and their arms are getting tired. This isn't just a supply shortage. This is supply shortage, plus massive industrial demand, plus naked short covering all happening at once. It is the perfect storm. Think of it as a pincer movement. On the left flank, you have the Chinese kill switch stopping new supply. On the right flank, you have the industrial demand from the Green New Deal and AI hardware requiring more silver than ever before, and stuck in the middle are the short sellers. As the price ticks up from $32 to $35, the banks have to engage in delta hedging, when market makers are forced to buy futures to cover their option exposure. This buying pressure pushes the price higher, which triggers more covering, which pushes the price higher still. It is a feedback loop of doom for the establishment. There is no escape from this squeeze because there is no spare inventory to bail them out. In 2011, they stopped the squeeze by raising margin requirements, changing the rules. They will try that again. But margin hikes only work on speculators. Margin hikes do not print physical silver bars for Samsung. The physical shortage overrides the paper manipulation. The trap is snapped shut. Real-world evidence, we are already seeing signs of this fracture appearing in the data. Look at the exchange for physical, EFP transactions. This is a mechanism used to move positions from the COMEX to London. The volume of EFPs has exploded, signaling that traders are desperate to find metal anywhere they can. Look at the premiums on American silver eagles, still hovering at 40–50% over spot price in some retail channels. Look at the recent import data from India. They imported nearly half a year's worth of global production in just a few months. Why would they do this now? Because the smart money in the East knows the window is closing. Furthermore, just last week we saw reports of delayed deliveries for 1,000-ounce industrial bars in North America. These are the wholesale bars, the foundation of the market. When the wholesale market gets tight, the retail market vanishes. While the media ignores this, the data from the Shanghai Gold Exchange shows record trading volumes. The metal is moving from weak hands in the West to strong hands in the East. So we have a supply cliff, a demand spike, and a banking cartel caught short. Now the question is, what happens to you? Here's what you need to understand. The price you see on your screen is a lie. It is a ghost. If you are waiting for the TV to tell you to buy silver, you are already too late. The decoupling has begun. What this means for you is that we are entering a period of extreme volatility, where the availability of the asset matters more than the price. If you hold paper silver, ETFs that are not fully allocated, or mining stocks with jurisdiction risk, you are in the danger zone. The system is designed to protect the big players, not you. When the force majeure is declared, they will settle your paper contracts in cash, depreciating fiat currency at a price they determine, while they keep the real metal. But if you hold physical, if you have it in your possession, you are the bank. You hold the collateral that the world is desperate for. This is a binary outcome. You are either holding the asset or you are holding the empty promise. The window is closing. You might wake up tomorrow and find that you simply cannot buy silver at any price. So, what is the play? Here is your strategic playbook for the coming crisis. Strategy number 1. Secure physical possession immediately. I am not talking about collectible coins with high premiums or numismatics that require a specialist to value. I am talking about weight. Get as many ounces as you can for every dollar you spend. Focus on 10-ounce bars, 100-ounce bars, and sovereign coins like maples or philharmonics if the premiums are low. Avoid paper-silver vehicles like SLV. They are the trap. Strategy number 2. Watch the ratios. The gold-to-silver ratio is currently sitting near 84.1. Historically, this reverts to 15.1 or even lower during a currency crisis. This means silver has far more explosive upside potential than gold. Strategy number 3. Prepare for the fake-out. The banks will likely smash the price one last time. They will dump paper shorts at 4 a.m. to try and trigger panic selling. Do not fall for it. This is their favorite weapon. If the price drops to $28 while the physical shortage gets worse, that is not a sell signal. That is a gift from the gods. Buy the dip. And finally, a warning. Avoid storage in banking safety deposit boxes. In a bail-in scenario or a bank holiday, you will be locked out of your own wealth. If you don't hold it, you don't own it. This is exactly what happened in Cyprus, and it's exactly what happened in Lebanon. Learn from history. Get your metal out of the system. Next week will be brutal. Not for the price, but for your emotions. They want you to panic. They are going to use every tool in their psychological warfare kit. You will see headlines about silver crashes, even as the physical premiums soar. You will see experts claiming silver is a barbarous relic. They will try to shake you out because they need your silver. They need you to sell so they can cover their shorts. You must build your psychological armor now. Understand that volatility is the price you pay for being right. If you check the price every 5 minutes, you will lose. You need to zoom out. Remember why you bought. You didn't buy for a 10% gain in fiat currency. You bought insurance against the collapse of that currency. When they smash the price, laugh at them. Know that every dollar down in the paper market is just a coiled spring for the physical market. You are fighting a spiritual battle as much as a financial one. Stand your ground. We are living through a historic pivot point. For the first time in 50 years, the East is telling the West that the days of paper manipulation are over. The kill switch has been activated. China has drawn a line in the sand. The supply is gone. The demand is exponential. The banks are trapped. And you? You are positioned correctly. If you have been stacking, if you have been preparing, congratulations to the diamond hands. You are the silent army that saw the truth when everyone else was blind. You understood the game while the masses were asleep. The wealth transfer is coming, flowing from those who trusted the paper promises to those who held the real things. From the fake to the real. From the indebted to the sovereign. They can print dollars, they can print yen, they can print euros, but they cannot print silver. They cannot print the sweat and energy required to pull real value from the earth. The dam is breaking. The water is rising. And for those of us with the metal, the ark is ready. Don't let them scare you out of your seat. We win, they lose. This is the end of their system and the beginning of yours. Stay strong.